to start, my talk is basically, there's two sides to any price equation, the supply and demand side. The demand is not easy to predict, and anything I tell you will probably be wrong, and I'm pretty okay with that. So what we tend to focus in on is on the supply side, because we understand the idea of long lead times involved in putting mines into production, and we also understand the low probability of an exploration play actually amounting to anything, especially in volatile commodity markets. So this talk here is basically a focus on the state of some of the major gold producers that basically right now in 2016, this will be based on 2016 data, full year data, that represent about 20% of 2016 production. Okay, so from my time working for a major gold producer in the Denver area, not naming any names, at their best, my thoughts about major gold producers was they provided portfolio diversification, which was a must. Assets, jurisdiction, stage, they do that. They provide liquidity, which is exactly what big institutional investors want. They provide you economies of scale, and this will come up again later in my presentation. And they also, because these deposits are getting bigger and bigger and require billion-dollar upfront capital investments, they, basically are a bit of a bank in terms of providing the financial capacity to put these things into production. The other thing is that they also have the human resources, so they can work on an open pit heap leach, they can do underground refractory ore, they can do a lot of different things. And one thing I didn't put up there was, something institutional investors like, is the dividends. And another thing I didn't put out there is they do offer investors the opportunity to indulge in a bit of masochism. So at their worst, the inability that they have to show meaningful production growth is a big issue. The weak returns on their capital employed, another issue. The hubristic M&A transactions that generated billions of dollars in write-downs. The bureaucracy and the inertia. Example is the cuts in G&A in Barrick and in Newmont a few years ago that didn't change any of their production. And there's also a tendency, because of the footprint of the projects that are required to move their needles, tend to become lightning rods for NGOs and governments. And we've seen that at Conga for Newmont, Pascua-Lama for Barrick, just to name quite a few. So are we asking too much as investors? Could the constant demand for reserve repletion, production growth trigger an extinction event for these kind of companies? Or are they too big to fail? So what I did was I went through a peer group of major gold producers. There were 9 gold producers. I basically focused on the North American producers. Their financials were the easiest to read. Their websites were the easiest to decipher, so I didn't go through the South Africans. Or the only Australian one I've got is Newcrest. So again, there are 9 companies here. The market capitalization cumulatively at the time that I did this was around 85 to 90 billion. And they collectively hold about 360 million ounces of gold reserves. They produced, as I said, about 20% of global production in 2016. And from that, they generated about $30 billion of revenue. So in terms of my review, and what I will point out at this point of the discussion, is this presentation was basically taken out of a letter that I produced in the first quarter, and that is actually free on our website. I'll tell you later in the presentation where it is, but you can get more details on it and the write-up in our website. So basically, I went through the valuations and the performance of each of these stocks. Market cap, share price performance, free cash flow yield, which I'll explain, EV per ounce. And then what I wanted to do was look at the reserves. So the reserves are a window into what they're going to be doing in the next few years, and then near to the medium term. And then importantly for us, I'll end with the idea of what are they doing with respect to exploration. So what is that commitment? And that commitment gives us an idea whether we invest in these junior explorers or prospect generators to basically add to their project pipeline. So the next graphic is basically their 2016 share price performance. I took this all as the US tickers because I benchmarked it versus the GDX, which is a benchmark for large producers. In 2016, the GDX was up 50%. So what I didn't do the absolute return of these companies, I did it versus the 50%. So if some company's giving you over 100%, they're giving you over 150% absolute return. Okay, so the benchmark for these large producers, again, was up 50% in 2016. That benchmark itself outperformed gold by over 5 times. The big companies, and let's demarcate this by the 10 billion mark, which is the black line on that on the slide, beat the benchmark 15% on average. But if you notice, Goldcorp, GG, the ticker, was down 34%, and it lowered the whole average. Oh, sorry. Whoa, 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 whoa. Okay, I'm just talking. Okay, sorry. So here, that's the benchmark in terms of 10 billion. Above this, I consider these the big ones, and these guys are the small guys. So right now, this performance right here is basically their performance deducting the 50% of the GDX. So this is their performance versus, so you can get a negative, like these guys. So all I'm saying is here, these bigger companies, on average, outperform the GDX benchmark. They did better than the benchmark on average by 15%. But since Goldcorp was down 34%, it weighed down that average. So if you look at it that way, you know, you could say that these guys actually outperformed the big guys, because on average, they outperformed the GDX by 23%. But that was all driven by IM Gold. And IM Gold beat the benchmark by about 120%. But their stellar run is basically supported by the fact that they're a very levered play. Their all-in sustaining cost is about $1,060, which is 20% above the average of the entire peer group. So they're a highly levered play that did very well in that moment. If you take that highly levered play out of the smaller cap ones, they on average underperform the GDX by 9%. So it's sort of saying, is bigger better? It might be. So this will take a little time to explain, but free cash flow is what I look at when I'm looking at a producer. And what free cash flow is if you take what they generate in terms of operations, deduct what they spend in terms of investing, that's your free cash flow. And that's what they can use to spend on dividends. It creates a lot of flexibility. They could pay dividends, they could buy back shares, they can service debt, they can reinvest in their own projects. But if you've got consecutive years of negative cash flow, free cash flow, that reduces your flexibility. You'll have to go back to the market, you'll have to take on new debt, and you're limited with respect to what you can do going forward. So free cash flow for me is very important. And so the metric free cash flow yield is basically a way of saying, how much am I paying for this free cash flow? So if you take their free cash flow per share, which I did for 2016, and deducted by their share price at the end of 16, I said, who's expensive, who's cheap? And so the denominator has to be very low. So the share price has to be very low for me to pay for that free cash flow. So the higher the number in terms of free cash flow yield, the better. But then when I was starting to look at it, I noticed that a lot of these companies were divesting assets. And so investing activity included the divestments. And so the biggest issue I had was with Eldorado. So Eldorado, if I just include their investing activities just for what they spent on their own projects to develop their own projects and sustain their own projects, their free cash flow yield was actually negative. But since they sold their Chinese assets for $900 million, their free cash flow yield looks fantastic. So if you took it like this, you go, wow, that's the company. But if you really look at it, it's not. So in terms of these major producers, the average free cash flow yield ends up being about 4%. And you could see that a lot of these divestments have helped Newmont, have helped Barrick, have helped Yamana, have helped these guys show a bigger free cash flow yield. But still, these companies are doing quite well in terms of where they are in share price and what potential yield they can give you. I mean, Agnico looks overpriced here, or overvalued, whatever you want to call it. And another anomaly might be Kinross, because once they included their divestments, I guess they didn't get any money for them, because they actually showed up as negative after, so I don't know what the heck they're doing. And another thing to remember is that all reserves are not created equal. And so one way of valuing reserves is taking the enterprise value. So enterprise value is just taking somebody's market cap, which I took at the end of 16, and said, take down their cash, add back their debt, I've got your enterprise value. So the average enterprise value per ounce was about $225 per ounce for the 9 companies. So looking at this, you can still see that, I mean, I'm talking still some pretty big companies here that are over $10 billion market cap that are getting paid a premium based on the peer group average for their reserves. So this is telling me that people are willing to pay a premium for some of these bigger cap companies and their reserve base. But what we noted was if we look at geopolitical risk, and we're just going to take this as flat, it's good to be in Australia, it's good to be in the US, and it's good to be in Canada, Newmont and Barrick are highly exposed, as is Agnico, to these 3 countries, whereas Goldcorp is not. So if you look at why Agnico had, if you go back, you see that premium that Agnico's getting, they're almost double the average, what they're getting paid for their reserves. And if we go to the next slide, we start to see why. They've got about double the grade of most of the peer group. So they're sitting at about 2.13 grams per ton, almost double the average. And that's why they're generating a premium of about $500 per ounce for their reserves. And that's why they'd be able to attract a $220 million sale of equity to one institutional client in March. So on average, the other thing you'll notice, maybe, is that the gold grades improved, actually. You know, not by much, by 1%. They didn't go down. But the largest positive impact was like Newmont, a big company. That's huge for them. But it's not because they found anything. It's because they got rid of some not so good stuff. So their divestments is helping them with their core assets. So the other issue in terms of reserves year on year is that they're declining. And we've pointed this out before in the Metal Investor Forum. And so these large economic deposits, as we know, it's hard to get a double-digit IRR, or internal rate of return, for these large projects that require multi-billion dollars of upfront capital, try to give them a $1,200 gold price, and try to make it work and give me a 15% IRR. It's next to impossible. So, and also the issue with these projects that we find is that they're bigger, so more technical, more execution risk, financing risk, and also because they have a bigger footprint, they tend to be harder to permit, if possible at all. The small gold deposits are nice, higher probability of giving you that return, but they don't move your needle. So if you look at it, look at Goldcorp. You know, last year they bought one side of the barbell, which was Kaminak, which was added 2 million ounces to the reserves. And now this year, they bought Kazpichi, Exeter, which adds, theoretically, 23 million ounces. So on average, reserves of their peer group declined by about 4%. The biggest decline was, again, issue with Eldorado. They got that big bump in free cash flow yield, but they got cut off at the knees with the reserves because all those Chinese assets were now out of reserve, and they dropped their reserves by about 20 to 25%. But what we've noticed is given the return that we showed you and the outperformance versus the GDX benchmark, it seems like reserve declines in this current market are palatable. So looking forward, the evolution of the species. So on one side, Barrick Gold might be an excellent example of a potential path forward for these endangered species, because they're using a reserve price of about $1,000 gold to 2020 before they go to 1,200. So this way they could generate free cash flow in a volatile environment. They're only focused on 5 core assets, and they're 70% of their 2017 production comes in at an all-in sustaining cost between $650 and $710. So that's what they're pushing. Hence the decline. So a lot of their stuff doesn't make sense at $1,000 gold, and so their production is technically declining. So right now, between 2016 and 2019, they're going from 5.5 to a range of 4.6 to 5.1. And so going rogue or contrarian is Goldcorp. So they've done this deal, a rather complicated deal, buying Exeter and buying 25% of Casale from Kinross and buying another 25% from Barrick, and continuing this thing as a joint venture between Barrick and themselves to operate and basically give them exposure to optionality in a stable jurisdiction and create economies of scale, which I will discuss in the next slide. So somebody can tell you, well, it looks like these optionality plays are in play, so I should just go on buy optionality plays. The problem here is that only one major is seeking optionality. The other major, Kinross, is walking away, and Barrick is trying to reduce their exposure to the optionality play. So this is a little slide for those economists out there about economies and diseconomies of scale. So if you looked at this, what Goldcorp's trying to do with their reserve base and where they need to get to, they're trying to create... Whoop. Sorry. Is that my wife? What's she calling you for? Anyway, so these economies of scale are trying to get them to a lower long-run average cost. And you can gain that. And that's the way a Caspice with a Cerro Casale would work, if at all. Where Barrick and potentially Newmont are at this set. They went too big, and now they're trying to go back. And so they're more involved in divestments and going back to a core that would take them back to this. So what you're looking at is majors on different parts of the evolutionary path and looking for different ways forward in a similar environment. So in summary, the share price returns still indicate that larger gold producers, those who are big market caps over 10 billion, can still outperform their benchmarks, meaning that they're still alive and kicking. Endangered, but they're still going. The 2016 free cash flow yields that also suggest that these companies can still generate good value and exceed their peer group. And importantly, not all ounces are created equal. The market has no problem paying a significant premium, almost 2 times, for Agnico's low geopolitical risk, 65% of their reserve base is in the US and Canada, high grade, twice the average of its peer group, gold reserve base. No issues. So in the near term, the other thing you want to take out of this is that investors seem to be okay with these depleting reserve profiles, which last year dropped 4% on average, as they're looking more for free cash flow generation from these companies. So that's all fine and good, but how does this impact us who are looking at junior marketplace, junior companies? So we have previously talked about the addition of quality assets depends on exploration. And so in this graphic, we're looking at basically exploration expenditures, but I'm not looking at absolute exploration expenditures, I'm looking at relative exploration expenditures. So how much are you spending on exploration? What is your budget versus how much you actually generated in revenue? The average of the peer group was about 3%. but it's volatile. But if you look at premiums, like we were talking about Agnico, how much they got for their reserves, a fact that somebody gave them, what was it, 200 or whatever $1 million in a private placement. But look at what they're doing with their exploration. They're way far and above their peer group with respect to what they're spending on exploration. They have no qualms understanding that exploration leads to discoveries and leads to value. Some of these guys have problems with that concept. But I'll note that Newcrest and Yamana have some of the biggest reserve lives. Like Newcrest, because they have low grade, like their reserve grade is about 0.6, because they deal in these large, low grade porphyries, they have a reserve life of about 30 years. But investors, past 8 to 10, they don't really care, because that's all Newmont and all Barrick have. So once you have that, they're fine. They don't need any more, because they understand the concept of drilling that out into the future. Nobody needs to drill out 30 years of reserves. They just happen to have it because of the nature of the deposit. So the group of majors under consideration spent about 3% on average of their revenue, which accounts for about $900 million of exploration expenditures in 2016. But most of this, the vast majority, was brownfields, not grassroots. And our whole contention is to find these deposits that work at 1,200 and provide these double-digit returns. There's got to be more grassroots exploration. So these low rates of exploration expenditure basically tell us that going forward, there's going to have to be an investment in exploration. But these companies seem more willing to do that investment in juniors. So for these majors, in the end, adaptation is the key to living in this volatile gold price environment. So not unlike the dinosaurs, it's not going to be easy for them to change, but the ones that adapt the quickest will survive. The evolutionary path by one, like Barrick, is to go to a core, give you double-digit returns, generate free cash flow. And this should work, in theory. The divestment of non-core assets has always proven easier than repopulating a core of high-quality assets. And this is the real key for us going forward, because we believe that without the significant global grassroots exploration programs that we need to have invested in, we will continue to look at investing in prospect generators, grassroots explorers, to fill this void, because we know that companies aren't doing it. So our investment thesis has been, continues to be going forward, that this assumption, acquisition of companies with technically competent management teams, capital market experience, exploring district scale packages, which is what the majors want, opportunity for high grade, and devoid of the fatal flaws in mining friendly jurisdictions. So lastly, I'll leave you with this. If you go to our homepage, which is explorationinsights.com, you could find this article that's got more details and the graphics behind it. And that's it for me with a minute to spare. Thank you.